Vancouver housing sales have come off their record pace in March and April, but there still seems to be lots of sales activity, and that's what we're discussing in today's Vancouver Real Estate Update, which is the newest segment in our Canadian Real Estate Update, where we're focusing on local markets. And if you like this platform, if you like this local focus, do me a favor, leave me a note in the comments below, and also do me that favor, hit the subscribe button and the notification bell so more people like you can see this video. Don't forget to hit that like button as well. And about our race to 25,000 subscribers, where one lucky subscriber is going to win $5,000 to put towards their RESP, RSP, TFSA, or just simply to pay down their mortgage. It's up to the winner. I sincerely hope it's you. Go ahead and click that subscribe button. It's free, it's easy, it's definitely worth it, and it's all you had to do to be interested. The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss the Vancouver real estate market and what is happening there. Now, not often do I criticize people, companies, organizations on pretty much anything on this channel. I've taken the approach that if I can't say nice things about them, I try not to say anything at all. And I'm not going to take a big stab at the Vancouver Real Estate Board or the Greater Vancouver Real Estate Board, but I am going to point out that their stats package does leave a little bit to be desired, and that they could probably do a little bit better job. The Toronto package, which you saw yesterday, has some really nice graphs, some really nice features, really easy to digest. And what you'll see today is that I'm going to actually use B&N Bloomberg for their article and their dissection of the Greater Vancouver stats, because quite frankly, it makes it a little bit easier to understand. And then I'll get into looking at the actual stats package from the Vancouver Real Estate Board here. So let's jump into it and take a quick look at the headlines here. The headline is this: Vancouver housing market is less intense in May, but sales listings still strong. So basically what happened is March and April across the country were record-setting months pretty much in every market. And what we're seeing is typically where a May would be even stronger than a March or an April, we're seeing things cool down. Now, this has been argued that it's lockdown, what's going on in Ontario. It's been argued that it is a decrease in the number of potential buyers, or basically an exhaustion of the buyer pool. And I think if you look at Vancouver versus Toronto, which was pretty much on a complete lockdown for last month, versus Vancouver, which has, yes, had some restrictions, some travel restrictions, but for the most part hasn't been locked down in quite the same way as the Ontario market. What you'll see is that very similar things are happening, which leads us to believe that it is not so much the lockdowns that are causing the reduction in the number of sales, but more the exhaustion of the buyer pool. So, really interesting numbers, and I think Vancouver points that out quite well when we look at it compared to Toronto, because very similar things are happening on opposite sides of the country. Now, when we go and we take a look at the numbers here, basically we're seeing a 13% drop in number of sales compared to the previous month, which was April. We have a hard time comparing this to the previous year because obviously it's a 174% increase in sales, May 2021 over May of 2020. And that is quite frankly because less things were happening in May of last year as people tried to figure out what was going on with the whole coronavirus pandemic and what they could actually go out and do. This was basically May of last year was still pre-change in preferences with respect to housing and pre-heating up of the market. So we're looking at April's numbers of last year, and essentially we are seeing that pretty much things are more. And what we're seeing is pretty much that things are cooling down from what they were in March and April, which I think is really interesting, because I think what that tells us is that we're going to see a little bit of a flatlining in the market and less of this exuberant, irrational increases in values, and hopefully less competing offers and less of a crazy overall market. Now, I want to take you into the actual news release and the actual stats package that was released by the Real Estate Board of Greater Vancouver. Sorry, I butchered their name twice as I was criticizing them for their not as pretty stats package, but yes, it is the Real Estate Board of Greater Vancouver. And this is their headline: home sales and listing activity in Metro Vancouver moves off of its record-breaking pace. And then they've provided some interesting numbers that were basically repeated verbatim in the B&N article. But what I wanted to point out here is the MLS Home Price Index, which is basically the price index that I think is the most accurate one across the country. Different markets use the Composite home price index, which I think is a really, really, really good way of measuring value because it measures a specific set of types of properties versus just the average price, which can be easily skewed by one really big sale or multiple really big sales or a whole bunch of really low price sales. And when we look at the Metro Vancouver home price index, it is at $1,172,800. This means that it is still the highest valued market in the country, and it represents a 14% increase over housing prices in May of last year. So not quite as crazy of an increase as we saw in other markets like in Toronto, but still a pretty substantial increase over last year. Now, what was interesting was when the Bank of Canada basically 2 or 3 weeks ago put out their assessment of the financial system. They had a graph in there that talked about over exuberant markets, and they had Montreal, Toronto, Hamilton, and Ottawa in those over exuberant markets. And Vancouver wasn't necessarily seen as one of those over exuberant markets. And the reason why, and a lot of people pointed out that my graph, by the way, that wasn't my graph, that was the Bank of Canada's graph, was wrong because Vancouver's market was equally crazy. But what we're seeing is that year over year, we're only seeing a 14% increase in housing prices. And we're seeing in Toronto significantly greater gains than that. And we're seeing people in the Ontario market believe that housing prices have nowhere to go but up. And if people don't buy in now, they're going to miss out on their opportunity to buy, which just isn't necessarily the case. So, this is really interesting that the Vancouver market isn't quite as hot as what some of the other markets are. Yes, it's still a high value, high priced market, but it isn't necessarily overheated in the same way that other markets are. And when I talk about overheating, what I'm referring to is craziness of multiple offers and people just going nuts trying to buy into that market and get in before it's too late. It's just not quite the same amount of craziness as it is elsewhere. Now, if we go ahead and we take a look at the overall price trends, and I'm going to make myself smaller here again, what you can see is that yes, housing prices in Vancouver are at record levels. They are higher than they have been in the past, and this makes sense because interest rates are lower than they've been in the past, and therefore people can borrow more while having the same monthly costs, and therefore we end up with the ability for people to pay more for houses and an increase in housing prices. So this is somewhat where we would expect it to be, given that we have lower interest rates. Now, if and when interest rates go up, and yes, that is a really, really, really big if, because it's not necessarily true that interest rates absolutely have to go up. If you look at the years between 1940 and basically 1955, there was very little increases in interest rates because the government was willing to keep interest rates low in order to make sure that consumers had the ability to purchase goods and services so that the economy continued to turn. And I think we are in that same sort of scenario where, yes, the Bank of Canada is saying that they're going to increase interest rates in 2022, but we could end up seeing interest rates remain low for longer if they need that buying power to continue to happen in order to keep the growth of the economy at a stable rate. So, this is going to be interesting because as interest rates increase, and yes, we saw this basically 0.5% increase in the qualifying rate, which is essentially a 0.5% effective increase in interest rates as far as buying power is concerned. Well, we saw that increase, and therefore what we should see, and we saw this in 2016, if you go back and you take a look at 2016, I'll bump you back into this graph here. If you look right here, this was when the last time there was a stress test that was implemented. Yes, at that point in time, it was a 20% decrease in buying power. And what we saw was a fairly substantial decrease in the housing prices. What I'm suspecting that we will see in the Vancouver market here, now that we have a 5% decrease in buying power across the board, is we're probably going to see this peak out and come down a little bit and maybe stay flat. Now, here's the thing. Even the best economists don't necessarily have the crystal ball necessary to predict where housing prices are going to go. I said this in the Toronto video yesterday. If you didn't tune into that, I'm going to say it again. If you just predicted that housing prices were going to increase at the normal rate of increase over the last 15 to 20 years, you would have been a better predictor of real estate prices than the best economists in the country. Yes, you would have missed out on the big jumps and the big bottoms, but guess what? So did the best economists in Canada. So basically, here's the deal. People need to stop trying to make real estate purchase decisions based on short-term data, what they think is going to happen in the next 3, 6, 12, 18, 24 months. And they need to start thinking about real estate in terms of longer term decision making. What is my next 5, 10, 15, 25 years look like? Not what is the next 12 to 18 months look like? Because people right now are trying to make buying decisions to get into the market based on short-term thinking. They've been doing this since 2016 when they thought that housing prices had to come down significantly more than they actually did. They thought housing prices would end up coming down to here. What ended up happening is they ended up being flat. And those people, based on short-term buying decisions, have still been in a position where they pretty much priced themselves out of the market because things happen in economies that we don't expect, and therefore we've had another increase in housing prices, and therefore people are having to pay more for the houses when they thought they were going to pay less. So stop thinking about real estate from a short-term perspective. It is not a short-term purchase. It is a long-term purchase that you need to think about from the perspective of 10 to 15 to 20 years and being in a market for 10, 15 to 20 years. If you know that you're going to be leaving a city, then probably purchasing isn't the right thing for you. If you know you're going to be only buying a house for a year at a time, probably not the right thing for you. But if you're going to be living in a city for the next 5, 10, 15 years, then make a buying decision based on your earliest opportunity to enter the market. Because the earlier you enter the market, regardless of if you're at the top or the bottom of the market, 25 years from now, it isn't going to matter. What's going to matter is that you're going to be slightly older if you decided to purchase later, when you actually have that opportunity to pay off your mortgage. And you're probably going to end up paying higher interest rates, because if interest rates do go up, you're going to be basically borrowing at a higher interest rate and therefore paying more long-term for the price of your house, not only because of higher interest rates, but also because housing prices are probably going to stay flat or increase over time. So if you're somebody who's looking to get into the real estate market and is lost on a lot of these things, we have a home buyers boot camp that we have put together. It is in progress right now. We've priced it so low that anybody who takes that course should get 10 to 50 times their money back. We've put in a special offer in that course so that if you do take the course, you're guaranteed to get at least 10 times your money back based on an offer from our company, Mortgage 360. Of course, you don't have to use Mortgage 360 to get your mortgage, but that offer is part of that course. And I sincerely hope that you take advantage of it if you're looking to get into the market, because it will save you from making all sorts of mistakes on things like how to choose a realtor, how to buy a house properly, how to avoid maybe getting the wrong mortgage or the wrong rate, and how to basically prepare yourself for the process so that when the right property comes along, you are able to get into the market. Oh, and one other thing we discuss is how to accelerate your down payment savings so that when housing prices do go up like they are now, you are able to save your down payment faster and ultimately get into a home sooner. If you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Again, let me know what you think of the local content, and don't forget about our race to 25,000 subscribers. I sincerely hope that you are the winner. We'll see you on the next video. Cheers.